3 financial signs that a company is declining. Do you know that out of the 30 companies that made up the Sensex in 1992, only 7 are still a part of it? Yes, that's true. The remaining companies couldn't maintain their growth and value and hence were thrown out of the list of the biggest 30 companies in India with time. Although becoming a large cap company is a dream for most businesses, however, after becoming a mature company, many companies find it a little challenging to maintain their growth. Moreover, the problem arises when they are not able to sustain their profitability and start declining. There are a number of examples of companies that were once market leaders, however couldn't keep a sustainable profit margin and later either shut down or went bankrupt. The most common example is Kingfisher. Declining companies do not have much growth potential left, and even the returns of their existing assets keep sinking. Therefore, as investors, it's really important for us to continuously monitor the growth of our invested company. And if we are able to find some signals that the company is declining, it might be the right time to exit from them. After all, no matter how much we love our invested company, the main goal of our investments is to make money. And if the company is continuously declining, there's no point in remaining invested. It's really difficult for the declining companies to reward their shareholders. However, we as investors have thousands of other options available to invest in the market. Then why stick with the declining companies? In this video, we are going to discuss the 3 clear signals that you can study from the company's financial statements which show that the company may be declining. Besides, these financial signs that a company is declining are very simple to identify even for beginners. Stay tuned till the end of the video to get a better understanding. Although evaluating the exact financial health of a company requires a serious study of the statements of profits and loss, the balance sheet, and the cash flow statements, there are a few financial tools that send an easy signal to investors in identifying declining companies. If all these financial signals are negative for a company, then the company might be in a little bit of trouble. Number 1, declining revenue. If a company's revenue is continuously declining for the past multiple years, it may be a warning sign for the investors. The revenue of a company is the top line of the income statement, and if the top line is declining in general, all the lower levels will follow the same trend. Even a stagnant revenue for a continued long period of time is a sign of caution for the investor. After all, there's a fixed extent up to which a company can control its expenses, and if the company wants to increase its profits, then it has to increase its revenue eventually. A flat or declining revenue for the past multiple years is an indicator of operating weakness. Moreover, if you can find that the revenue of the competitors is growing over the same period, then it sends an even stronger signal of weak management and poor health of the company. Number 2, negative profit margin. Profit margin is calculated by dividing the net profits by net sales realized over a given time period. It represents how much percentage of sales has turned into profits. In other words, the percentage figure indicates how many cents of profit the business has generated for each rupee of sale. If the profit margin of a company is negative, it shows that the company is not able to generate profits from its regular business. A negative or declining profit margin of the company for a continued longer period of time can be taken as a warning sign for the investors. Declining companies generally lose their market share to their competitors, and in order to keep their sales up, they often have to give either bigger discounts or cut the profits. Moreover, they also lose the pricing power, which further leads to a fall in the margin. While evaluating companies, you can look at 3 levels of the profit margin: the gross profit margin, the operating profit margin, and the net profit margin, each being a more refined level of profitability. As a rule of thumb, avoid investing in companies with a negative profit margin. Anyways, if you've already invested and now find that the profit margin of the company is continuously declining for the past multiple years, then it might be a signal that the company is in decline. Number 3, big dividend payouts. Dividend payout is the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. It can be calculated by dividing the dividend per share by the earnings per share of a company in a year. For example, if the dividend per share of a company of the current year is rupees 2 and its earnings per share is rupees 10, then the payout is equal to 2 by 10, which is 20%. If a company gives a consistent dividend to its shareholders, it is a healthy sign. However, the problem arises when the company starts paying a major portion of its net income as dividends. In such a scenario, the company is not retaining enough income for investment in its growth or future plans. There should be a balance between rewarding shareholders and retaining income for its own growth. After all, if the company is not investing enough in itself, it will eventually become difficult for them to increase their profitability in the future. Declining companies generally pay out large dividends to their shareholders as they have very little need for reinvestment. As a rule of thumb, a payout ratio greater than 70% for a company can be a warning sign for investors. Another financial tool that can give you a better picture of the financial situation of a company along with the above three financial indicators is the company's debt levels. If the debt level of a mature company is continuously increasing at a high pace, it is a sign that the company has been aggressively financing its growth with debt. You can use the debt to equity ratio to evaluate the debt level of a company. A high debt to equity ratio can be considered high risk for the company. Apart from that, there are also a few handful of financial ratios like return on assets, return on equity, and interest coverage ratio. You can study these to check if your company is declining. A continuously declining ROA, ROE, and interest coverage ratio can be a warning sign. Even big mature companies are capable of declining over time and losing their value. And that's why it is important for investors to continuously monitor the growth of their invested company. In general, a flat or declining revenue, negative profit margin, and huge dividend payout can be considered financial signs that the company is in decline. Anyhow, if the company takes necessary steps, it may recover back on track or even become a turnaround. However, if the management doesn't take the significant steps in time, the company might decline further, destroying the shareholders' investments. We hope that you've liked the video and it has helped you in a way to stay away from such companies while investing. Tell us if you found this video helpful in the comment section, and also tell us what you want to see in the future. Subscribe to stay up to date, and thank you for watching. Happy investing!